Welcome to Thimbleberry U. I'm Michelle Odell, your host, and with me for more great information is President and Financial Advisor Amy Walls of Thimbleberry Financial. Hello, Amy.
Hi, Michelle. It's great to be talking to you.
Great talking again. This makes a lot of sense. The retirement trifecta. Income, assets, expenses, and it's all about balancing. So let's get right into it. What is the retirement trifecta, and where did this name come from?
Yeah, the retirement trifecta is just something internal we kind of came up with because so often something was needed to refer to this. And it's really the idea that there's three main components, as you mentioned, income, assets, and expenses, that most of successful retirement planning rolls up into. All three of these things have to be in balance for someone's assets to last a certain amount of time, such as through retirement. It could also come up, right, when someone is maybe pausing work for a while for whatever reason, or maybe has kind of a early retirement and then is planning to go back into a new career and then fully retire from that career. But it's whenever we need expenses to be covered and there's assets and income that can do so.
Let's explain to everyone how this all works together and in balance.
Think about an equilateral triangle. That's one where all the corners are the same angle and the sides are the same length. And in one corner is assets, one corner is income, and one corner is expenses. So if we think about retirement in this case, how retirement, in my mind, and how we work for clients, being that we are always goal-based planning, okay? We aren't planning for people to say, well, this is how much money you have, so here's how much you can spend. We like to approach it from the angle of, here's the lifestyle you want to live. How do your assets and income make that happen? What has to happen to get those to the place where this can all work? And so if we think about covering those expenses, let's look at, well, whatever income's coming in gets to offset those expenses. And if there are more expenses left over, well, then assets are going to have to be used to cover those expenses. And so really expenses driving the picture is how we approach it.
So as an advisor, how do you help people with this?
As an advisor, I give advice to our clients as to what needs to happen to bring those items into balance. Most often, and preferably, our advice isn't a conversation about all three things together, but a conversation about the actions that will grow the assets for retirement, right? Because those assets are going to help fill in the gap. That may be about better asset diversification or tax diversification. Hint, hint, I'll say podcast number 1 because tax diversification is like the thing that most often is overlooked by people. It's risk return ratios on investments. It's their contributions to certain accounts, that type of thing. With income, our conversations may be about the best time to start drawing on a pension or to take Social Security, or maybe it's how rental income fits into the puzzle. Ideally, because we are goal-based, we hope to not need to say much about the expenses. Right? Sometimes we get to say, hey, guess what? You can spend more. Like, are there some other things you want to do in life? Like, that's a really great, lovely conversation of helping people get more out of their life. Other conversations around expenses might be around if it's beneficial or not beneficial to have a mortgage in retirement.
Okay.
I'll share, in my almost 20 years of doing this, I've seen it both ways. And that depends on the makeup of clients' income and expenses and assets, as well as their personalities. Sometimes, though, when expenses are a conversation that we have to talk about, it's that the expense load is too high. This desired lifestyle is too high for getting the income or the assets to where they need to be to cover the expenses.
Okay. So if the expense load is too high, are you able to get fancy and creative with the income and assets?
Michelle, I so love that you asked that. I'm a big fan of Brené Brown and the stories we tell ourselves. And every time I need to have a conversation with someone that the expenses are too high, the story I tell myself is that that's what they're saying in their head. So I'm so glad you asked that. The reality is that what we can do with assets and income really only gets so far if that expense piece is too heavy. So, for example, in some situations, if the expenses are out of proportion now and are expected to stay at that same level, then what that high expense threshold is doing is it's stopping the ability to save now and later, which then kind of compounds and makes the asset section not be able to grow towards the expenses. So you just continue to get more and more out of balance the longer that stays. So there are things, the fancy and creative. They're the things that I already talked about a little bit, or touched on, I should say, with assets and income in addressing questions. But unfortunately, when that expense load is too high, those things will just not make a big enough difference.
So what you're saying is if you're spending too much now, your future self is getting the short end of the stick. So is there a correct ratio of these three items that equals success?
I love that you said that your future self is ultimately getting the short end of the stick. And I think it's important to remember that we want clients to get what they want out of life.
Right.
And so for some people, saving extra right now to have this life tomorrow isn't what they want. They anticipate some big changes that will allow them to catch up. Maybe it's while their kids are younger, they want to be doing X, Y, and Z with them, and that's going to cost more than what they anticipate doing in the future. And they're really clear about that. So it is about finding balance for each person, just like we're talking about finding balance for these three things. So is there a correct ratio? Yes and no, right? My special it depends answer. The right ratio is the ratio that fits what you want to get out of life and what's going to get you there. But it is not an off-the-shelf solution.
Okay.
And we have to look at what's important to you today, what's important to you tomorrow, and how do we marry those things together. Let's use me as an example. So I'm 46 years old, making that very public right now. And I have to say, in the last year, I have found a love of downhill skiing and boogie boarding.
Fun.
I live in Portland, Oregon.
Of course.
I hadn't skied really since I was, a kid, and really got back into it this year. And then on vacation, I went, gosh, boogie boarding. I want to do this with my grandkids. My husband and I were in the ocean, and I said, I want us to be doing this with our grandkids. We need to take steps now to make sure we are healthy enough to do that. And then, I want to be able to camp with my grandkids. I'm talking all about grandkids being 46 years old, but it really has recently, especially from the skiing, jumped out at me at how much I'm looking forward to that in my retirement. At the same time, I also have a really hard time imagining that I will be someone who has a hard stop on working.
Exactly. You love what you do.
I totally love what I do.
Yeah.
And as many of our younger clients, I imagine that I will phase into retirement because I do love our clients and I love this work. Therefore, what I can imagine, what I anticipate in my own planning is that some of my expenses in retirement may be higher due to some of those activities that I want to do.
Exactly.
Right? If I want to take my grandkids skiing, my kids may not be at a place to afford all of that at that point. They may not be able to afford the vacations. Now they're banned from listening to this podcast because I don't want to give them any expectations. But I want to be prepared for that and encourage them to be successful along the way. But because I can't see myself just stopping working, I will have income coming in for a longer period of time than probably most people. But someone else who could be 46 might want to stop working at 55. And they may want to spend their time reading and gardening. Don't get me wrong, I love those things too.
But they don't cost as much as skiing, that's for sure.
Absolutely.
Right.
And so they're going to need a lot less in terms of income or assets to cover that expense threshold if all other things are equal. So
that makes sense.
That's why I say it's not an off-the-shelf solution. It's very personalized to what someone needs.
Okay, now, so what are some of the biggest misunderstandings you see around this topic?
Let me start with assets. Here's one. Rental property may be being counted as both income and assets as a way to cover expenses. Now, obviously, a rental property is going to show up on someone's balance sheet, so it's part of their net worth. But you can't use the equity, in a sense, from that rental real estate and the income stream towards retirement. You
Okay.
get one or the other, right? If you have a rental property, income's coming in to offset expenses, or you're selling the property and now it's an asset that's going towards covering those expenses. But it doesn't get to be income and asset both pouring in to cover expenses. And I think in our head, somehow that becomes a little bit harder to think about when we say, oh, I've got this rental property and it's going to do these things.
Right.
I think another misunderstanding is just that idea. I think you used the words fancy and creative, that as financial professionals, we have extra secret tips to make income and assets work harder that can solve all problems. I'm part of a few groups of advisors. I know a number of advisors. I know we all wish we could do this, and I can speak for the group collectively on this, I believe. I can speak for the whole profession on this. We'd love to be able to do that. But those talents only go so far when you look at the actual math. Another misunderstanding is that expenses, and I think we've touched on this today, so I hope our listeners have heard it, expenses don't matter that much, because once expenses exceed what's realistic, then they're going to have to be pared back to get into balance. And that paring back is hard work once you've experienced something. So I think the better option is avoiding them getting too big in the first place. And once you do know and you've done that work, be really cautious, because it's a little demoralizing to, I got this. Oh, pare it back. Oh, did it again, pare it back. And I think that's where kind of people lose motivation. I think a lot of times, if we think about debt in this case, and I know that wasn't part of our conversation, but that's kind of where debt will spiral out of control in many cases for people.
Probably questions people will have, and they can get in contact with you in what way, Amy?
Yeah, they can reach us online or by giving us a call. Online, we can be found at thimbleberryfinancial.com. And our phone number is 503-610-6510.
Okay. Until we meet again, have a great couple weeks. We'll talk to you soon.
Sounds good, Michelle. Thank you.
Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through registered representatives of Cambridge Investment Research, Inc., a broker-dealer. Member FINRA SIPC. Advisory services through Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and Thimbleberry Financial are not affiliated.